everyone is familiar with the debt problems confronting Europe, but recent research by UBS offers details around how the problem can be confronted, how long it will take to overcome, and where investors should be investing their money in the meantime. Warren Dick caught up with Costa Vallenas, the head of emerging markets research at UBS, to discuss these topics.
We have this ongoing scenario in Europe which seems to be driving a lot of the sentiment in world markets at this point. And we just wanted to understand from someone who's based in Europe and a European bank, how is this European debt crisis going to play out, and what can investors expect from certain asset classes going forward in terms of returns that they'll be able to enjoy?
Right. Well, I think there are two aspects. The first is a shorter term one, where we've always said that one way out is for the European Central Bank to print money and help relieve short-term pressures. But longer term, the issues are far more protracted. The debt levels that you have in Europe overall are extremely high. Even Germany wouldn't qualify to be in the Eurozone today because its debt is above 60% of GDP. And so the impact, one of the impacts really is that we're going to be faced with this problem for many, many years. High debt levels of debt, and the implications for different asset classes will be linked to governments trying to deal with this debt.
Now, one of the slides that you gave in your presentation was around showed the pre-Maastricht or the Maastricht Treaty agreement in terms of these European countries sticking to certain debt limits. What transpired to get us into this situation? I'm always intrigued to find out, they had this agreement when they entered the European Union that they were going to stick to certain fiscal targets, and over time, over the last 10 years, these have just been completely exceeded. What are some of the reasons that Europe finds itself in this position at the moment?
I think there were two things. The one is that there was very gradual slippage of these debt levels. They weren't really a big focus of markets. So budgets, the deficit targets were larger than they should have been, and markets didn't really focus on this too much. That was the one issue. But the real knock, I think, was the global financial crisis, which suddenly brought a recession. Revenues collapsed, and with that, the state basically had to intervene in many areas. And that was the explosion of debt that you saw. So you had a kind of a double whammy effect.
The picture that you paint and the picture that we see is an emerging markets world that's almost the complete polar opposite of Europe. What are some of the reasons why emerging markets have behaved so well in managing, especially their fiscal position?
Yes, this is a strange aspect to the current crisis, in that the countries that were strong are today weaker, and the countries that are weak are a lot stronger today. And one of the reasons is that many emerging markets have gone through the exact same crises. They've had defaults. Russia defaulted. Indonesia had its banking system wiped out. And through this very difficult history, many of the emerging markets pursued a more prudent fiscal path. And one of those lessons was you need to have more cash. The state needs to have large foreign exchange reserves. Fiscal policy should be a lot more prudent. And in fact, up until 2007, 2008, that's what emerging markets were doing, because they thought this is the right thing to do for them. And now that the crisis is here, we're half a decade into the crisis, these fiscal numbers for the emerging markets on the whole still look very, very good, very healthy. Just yesterday we had Turkey upgraded to investment grade, and you've had several emerging markets upgraded over the last 3-4 years. So in the middle of the crisis, when advanced economies are being downgraded, the rating agencies are simply validating the facts. The numbers in the spreadsheet for the emerging markets on the whole are still very good.
Now, it's quite interesting because obviously, as I mentioned, very, very opposite positions, the emerging world versus the developed world at this point with their fiscal positions. And I wanted to ask you, many years ago we had the Washington Consensus that was part of the ingrained philosophy at multilateral institutions like the IMF and the World Bank. What role have they played in the emerging world? Has it been one that they've sort of imbued them with a sense of fiscal responsibility? And some of those things like the Washington Consensus brought very sharp and painful austerity measures to countries that had ballooning public debt. Have they played a role in this scenario on the side of the emerging market countries?
So for many years they did, because the emerging markets said we don't want to go through the hyperinflations and the banking collapses and all the difficult periods that we had in previous years. How can we avoid that? And basically they took the Washington Consensus, they downloaded from the EU the Maastricht Treaty, which said don't go above 60% in terms of debt, be prudent with your fiscal balances. And I think what has happened now is that these countries that propose this Washington Consensus are damaged, right? Their credibility is not there. Right. This is causing confusion, not least amongst fund managers, because what was good is less good today. And it also risks damaging the emerging markets' ability to stick to a very prudent path, because if the US has deficits of -6, -7, suddenly a -3, a -4 doesn't look too bad in some emerging markets. So I think it's damaged a prudent path globally.
Okay. Now, just in terms of some of the work you've done, looking at, you've turned your perspective back and tried to understand from an historical context how long it takes to right the ship, so to speak, and get the public finances of the developed world back on track. Some people are saying we could have another lost decade. It's been 5 years since the start of the global financial crisis. How long can this thing take to unwind to a position where developed countries can go into the front foot and really start to see strong GDP growth again?
Well, the first thing that we know, history tells us, is that these debt cycles are very protracted. This is not something that you're going to fix in the next 5 to 10 years. We're talking several decades, actually. And these governments are trying various ways to deal with this issue. And one of them is extremely low interest rates. So they want very low interest rates at the short end. They're intervening to keep rates low at the long end in several cases. And in addition, you have all these prudential rules that are forcing the private sector to buy this very low yielding paper, right? So for example, in Switzerland, the 10-year government bond yield pays you 0.5% per year, right? So that's in my pension fund because those are the rules. So this gives you a sense that these very low rates are also eroding savings and also causing damage.
So we have the spectre of a very low yield world for perhaps not even 5 or 10 years, but possibly a couple of decades to allow these countries to come back into balance in terms of their fiscal position. Part of what your thinking has been in the research that you've been doing recently is talking about how emerging market currencies are going to react to this ongoing quantitative easing and the extremely low interest rates that we see in the developed world. Which brings us to the asset class of emerging market currencies, something that you have some fairly interesting views on at this point. And just, I think, for the benefit of viewers, if you could just lay that out and give us your perspective on why you think emerging market currencies are going to be a very strong asset class for the next few years.
Yes. So first of all, we expect interest rates in the more developed markets to stay low for a very long time, because this is one way to deal with their debt issue. By contrast, the emerging markets are less indebted. Their economies are growing somewhat faster. They also have more inflationary pressure, which means that their interest rates are higher and likely to continue to be higher for quite a while. So you're getting yield at the very short end. If you look at interest rates in Indonesia, in India, in Russia, in Brazil, in Turkey, so you don't even need to go long term, just the very short end you're getting a high yield. And more investors sitting in Europe and the US and elsewhere, faced with these low rates, are asking how they can benefit from this higher yield. Now, what they're afraid of is the fact that when you buy an emerging market currency, you're buying into a very volatile instrument typically, and this is what has sort of held investors back somewhat. But the new thinking, or thinking that is growing, is that by putting these volatile currencies into a diversified basket at the short end, you can reduce the overall volatility of this basket. So you would have in there, say, the Indonesian rupee, the Brazilian real, the Turkish lira, etc. These currencies act differently from day to day, but first of all, they give you a high yield, certainly higher than you're getting in Europe or the US, number one. And over time, as these economies become wealthier, the value of their currencies should tend to increase in value. Right. And so when you put this together, you tend to have an asset class, and it's controversial to refer to emerging market currencies as an asset class, but we'd like to think of it as an asset class. You have this asset class outperforming the G4 currencies, G4 being US dollar, euro, yen, and sterling. And this is not a story that's going to go away anytime soon, because it's driven not only by what is happening internationally, very low interest rates for a long time, but also more and more investors in the emerging markets are more confident to hold more of their assets in local currency instruments. It's true in Brazil, it's true in Turkey, it's true in Indonesia. And that's good news for us as investors, because we want to invest in markets where the locals feel more confident about their currency.